Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palo Alto Networks.
If you find our talks useful, please consider subscribe, like, and comment underneath. All right, let's get right into the thick of it. It is Wednesday, February 18th, 2026, and if you were watching the After Hours tape yesterday, you probably saw something that made you spill your coffee. Palo Alto Networks dropped their Q2 earnings, and the market just took a sledgehammer to the stock. We're talking an almost 8% drop post-market.
It was a violent reaction, definitely. And honestly, if you were just skimming the headlines on your phone this morning, you are probably incredibly confused.
Oh, completely.
You know, you have one camp screaming earnings beat, and then the other camp is screaming guidance disaster. It's a classic case of, well, market schizophrenia.
It really is. I mean, usually when a stock takes an 8% haircut instantly, it means something fundamental is broken. You know, the business model is cracking or revenue is falling off a cliff. But when I looked at the actual scorecard for Q2 2026 this morning, it didn't look broken. It looked, well, surprisingly robust.
So help us cut through this noise. What actually happened with the numbers?
Yeah, if you look at the raw execution, they did exactly what they were supposed to do. Let's look at the bottom line first. Adjusted earnings per share, it came in at $1.03.
Okay.
Wall Street, the consensus of all those highly paid analysts was only expecting 94 cents.
Wow.
And if you zoom out a bit, that's up from about 81 cents a year ago. That is legitimate, double-digit profit growth. They're making more money per share than anyone thought they would.
Okay, so profitability is up. That's usually bullish. What about the top line? Are they actually selling more security?
They are, yeah. Revenue came in with a slight surprise to the upside. It wasn't a massive blowout, but they beat estimates by about 0.5%. So you have a revenue beat and a significant earnings beat, which brings us back to the paradox. We have a beat on the top, a beat on the bottom, and the stock gets absolutely crushed. Is this just a sell the news event, where traders are taking profits? Or is there something actually wrong here?
It's not that something is wrong, but there is a very specific sticker shock happening. The market is reacting almost entirely to the guidance.
The guidance.
Specifically the profit guidance for the rest of the year.
Yeah.
Palo Alto management came out and they trimmed their profit outlook. They're basically telling us we are going to make a little less profit in the next few quarters than we previously thought.
And Wall Street hates that.
Yeah.
But why? Is the business becoming inefficient? Are they getting bloated?
No, it's not operational inefficiency. It's intentional spending. Their expenses are spiking because they went shopping. We saw deal costs specifically related to acquisitions jump from a very manageable $10 million previously to about $24 million this quarter.
Ah, okay. So this is the cost of doing business when you're in M&A mode.
Exactly. They are in the middle of a very aggressive strategy to acquire new technology. And the algorithms that trade these stocks, they see margin compression and lower guidance, and they just instantly hit the sell button. It's a knee-jerk reaction to the short-term balance sheet impact.
It feels a little short-sighted, doesn't it? I mean, I always use this analogy. It's like getting mad at a homeowner for draining their savings to put on a new roof and renovate the kitchen. Yes, the bank account looks worse today, but the asset, the house, is worth significantly more. You're building equity.
That's a very fair analogy, but I would add a little nuance to it. The market hates uncertainty. When you renovate a kitchen, you know exactly what you're getting. A new stove, some countertops.
Sure.
When a massive tech company spends billions on acquisitions, there is execution risk. The market is effectively saying, prove to us that this money is being spent wisely before we give you credit for it. They don't want to pay for the potential. They want to see the results.
That makes sense. The market is in show-me mode. So let's look at what they're actually building with all this cash. If we strip away the panic about the $24 million in deal costs, what does the engine under the hood look like? Because in the report, I kept seeing this acronym NGS over and over again.
And this is the single most critical part of the deep dive. If you want to understand where the wealth will come from in this stock over the next 5 years, you have to ignore the old school hardware firewalls. You need to focus entirely on NGS next generation security.
Okay, so let's define that clearly for everyone. We aren't talking about physical boxes you screw into a server rack anymore.
Correct. This is cloud security. This is AI-driven threat detection. This is software-based solutions that live where the data lives. It's the future of the company. And the growth here is it's absolutely explosive. In this quarter, NGS annual recurring revenue, basically the subscription money they can count on every single year, surged 33%.
33%. That is a big number.
It hit $6.3 billion.
Okay, I want to pause there because I don't want that number to fly by. Growing at 33% is impressive for a startup making $10 million.
Right.
But growing at 33% when you're already at a scale of $6.3 billion, that represents a massive amount of new money flowing into the system.
It does. It shows huge momentum. And that's why I think the bearish reaction to the profit trim is a mistake. That $6.3 billion is high-quality revenue. It's sticky. Once a company moves their security architecture to the cloud with Palo Alto, they don't just switch it off. And here is the detail that the bears are completely ignoring in the headlines. While Palo Alto trimmed their profit guidance because of the deal costs, they actually raised their full-year revenue outlook.
Wait, really? So they expect to bring in more top-line money than they thought 3 months ago?
Yes. They bumped the guidance range up to between 11.28 and 11.31 billion. Previously, the top end was around 10.5 billion. That is a massive signal of confidence. Management is essentially telling us, yes, it costs us money to put these deals together right now, but customer demand for our platform is accelerating faster than we thought.
That changes the narrative completely. The thesis shifts from companies are spending less on security to Palo Alto is spending more to capture a growing market.
Precisely. And they're doing it through this strategy they call platformization.
I have to be honest with you. Platformization sounds like terrible corporate bingo jargon. It sounds like something a consultant made up to charge $500 an hour. Does it actually mean anything in practice for the product?
In this specific industry, it actually does mean something vital. Think about how cybersecurity used to work, say, 5 or 10 years ago. You'd buy a firewall from Cisco. You'd buy endpoint protection from CrowdStrike.
Like a bunch of different vendors.
You'd buy cloud security from Zscaler or someone else. You had 20 different vendors, 20 different dashboards, and none of them talked to each other. It was a nightmare to manage.
It's like trying to run a smart home where the lights, the thermostat, and the locks are all on different apps and don't speak the same language.
Exactly. Platformization is Palo Alto's bet that companies are sick of that mess. They want an operating system. One dashboard, one vendor, everything integrated.
Like the Apple ecosystem. You tolerate the walled garden because your watch talks to your phone, which talks to your Mac, and it just works.
Correct. But in security, it's not just about convenience, it's about speed and efficacy. And this is where we need to get a little technical to understand the moat.
Okay.
We need to talk about data scale. Palo Alto is currently processing 1.5 trillion events every single day.
1.5 trillion. That number is so big it almost loses meaning. What does that actually look like?
Think of it this way. Every one of those 1.5 trillion events is a data point. It's a potential threat, a user logging in, a file being transferred. Because they see so much traffic across the entire globe, their AI models are training on a data set that almost no one else has access to. This is their precision AI. They're claiming 99.7% threat detection accuracy.
So it's a network effect. If I'm a customer, I'm safer because you're a customer. If the AI sees a brand new attack on your network in London, it learns it, patches it, and blocks it on my network in New York instantly.
Exactly. And that data scale creates a moat that is very, very hard to cross. A smaller competitor might have great technology, maybe even better code, but if they don't have the data scale to train the AI, their system just won't be as smart.
And you mentioned throughput. That's basically how fast it processes all this without slowing everything down.
Right. In the enterprise world, you can have the most secure lock in the world, but if it takes 10 minutes to open the door, nobody will use it. You need speed. Palo Alto is clocking 1.44 transactions per second in their verified tests.
And how does that compare?
Compare that to Fortinet, their biggest legacy rival, which is sitting around 0.52.
Wow. So they are nearly 3 times faster. That's not a rounding error. That's a fundamental difference for a bank or a hospital running high-speed applications.
And that speed combined with that integration creates lock-in. We can see it in the customer retention numbers. 85% of the Fortune 100 are already on the platform.
Okay.
But the metric I love, and the one that really signals smart wealth, is the net revenue retention, or NRR. It's sitting at 125%.
Okay, so let's unpack NRR for the listeners who don't live in SaaS metrics every day. Why is that number so important?
It measures the spending of your existing customers. An NRR of 125% means that if a group of customers spent $100 last year, that same group is spending $125 this year.
Got it.
They aren't just staying, they're buying more. They're adding modules, adding seats, upgrading tiers. That is how you build a compounding wealth machine. You don't even need to find new customers to grow. You just need your existing customers to deepen their relationship.
Which explains the spending spree. If you want them to buy more stuff, to go from 100 to 125, you have to have more stuff to sell them.
Precisely.
So let's talk about these acquisitions that wrecked the profit guidance yesterday. This wasn't just buying a small app for a few million. They went big.
Huge. The headline grabber is obviously CyberArk. That represents a $25 billion deal.
$25 billion. That is a merger, not a tuck-in. Why CyberArk? What does that give them?
It's all about identity. CyberArk is the absolute leader in privileged access management. In the old days, you secured the perimeter, the firewall around the building. But in the cloud, there is no perimeter.
Right.
The perimeter is your login. If a hacker gets your credentials, they are inside the house. By buying CyberArk, Palo Alto is saying, we're going to own the identity layer too.
So they own the network, they own the cloud, and now they own the keys to the front door.
Right. It positions them to completely shut out competitors who only do one piece of the puzzle. Then you add Chronosphere, which was a $3.35 billion deal. That's for cloud observability.
Which is?
Basically the ability to see deep inside complex cloud infrastructure to find problems before they happen. And then Koi, which is a smaller targeted buy for specific AI capabilities.
It sounds logical strategically, building the ultimate bundle. But I have to play the skeptic here. $25 billion is a lot of money, and integration is hard. We've seen massive tech mergers fail miserably before. Cultures clash, products don't actually talk to each other, engineers quit, and you end up with a Frankenstein monster.
That is the single biggest risk. You hit the nail on the head. The bear case here isn't that the cybersecurity market is disappearing, it's that Palo Alto gets indigestion.
Right.
Integrating a company the size of CyberArk is a logistical nightmare. And if they get distracted by the merger, sales teams might get confused. What am I selling? The old product or the new one? And while they are distracted, you have hungry wolves waiting.
And we have to mention the competition. Who is nipping at their heels?
The biggest threat right now is probably Wiz. They are a cloud-native security company. They are incredibly fast, they are easy to deploy, and they are eating market share in cloud security. They don't have the legacy baggage, the old hardware business that Palo Alto has.
Okay.
So if Palo Alto's all-in-one platform becomes clunky or hard to use because of a bad integration, customers might just say, forget it, I'll use Wiz, it's easier.
And ease of use is a powerful motivator. There's also a macro factor here, right? We tend to think of cybersecurity as recession-proof. You can't fire your security guard, but is it really?
It's more resilient than most sectors, but it's not immune. The dark irony of this industry is that it relies on the bad guys getting smarter.
Right, yeah.
The business model is driven by AI threat escalation. We need hackers to use AI so that companies feel forced to buy Palo Alto's precision AI. If the threat landscape were to somehow calm down, which, let's be honest, seems highly unlikely given the geopolitical state of the world, spending could slow.
So we have a clear picture. A market leader, growing fast in the right areas, NGS spending heavily to dominate the future, but taking a short-term hit on margins to do it. The stock is down 8%. Is this a falling knife that we should stay away from, or is it a gift?
I'm looking at the next 3 to 6 months. The next big checkpoint is Q3 earnings, likely in late May.
What's the specific number we're watching?
NGS ARR. If that number slips below the 30% growth range, or if it doesn't comfortably push past that 6.3 billion mark, then the thesis is in trouble. That would mean the platform strategy isn't working or the competition is winning.
And we need to hear good news on the integration.
Actually, we need to hear boring news on the integration. We want to hear that it's proceeding as planned, no surprises, no drama. Boring is good when you are merging huge companies.
So, verdict time.
Right.
How does SmartWealth score this setup?
I'm giving this a bullish score of 8 out of 10.
That is high confidence given the red ticker today.
Yeah.
So give us the elevator pitch for the listener who is hesitating because of that drop.
Here's the logic. You are getting a market leader with industry-leading gross margins of 77%. You have a growth engine in NGS that is expanding at 33% a year. You have a competitive moat data scale and platform lock-in that gets stronger every single day.
And the drop.
The 8% drop is a reaction to $24 million in deal costs while ignoring billions in future value those deals create.
So you think the market is stepping over dollars to pick up pennies?
I think the market is throwing a tantrum because it didn't get instant gratification on the bottom line.
Yep.
But if you have a multi-year horizon, this is a dip-buy setup. You are buying into the platformization inflection.
But to be clear, this isn't a quick flip. You don't buy this today to sell it next week.
Absolutely not. This is a hold while they integrate CyberArk and cement themselves as the Microsoft of cybersecurity. It's a volatility play. You have to be willing to stomach some choppy waters while the merger happens. The payoff is on the other side of that integration.
It reminds me a bit of Amazon in the early days. Every quarter, people would panic because Bezos spent all the profit on warehouses and logistics. Oh no, margins are down.
Yeah.
Yeah, because they were building the infrastructure to dominate the world.
That's the comparison I keep coming back to. Palo Alto is building the digital infrastructure to secure the world. It's expensive to build, but once it's built, it is incredibly hard to displace.
So here is the final thought I want you to chew on today. We often talk about moats in business. Usually we mean a brand like Coke or a patent like a drug company. But in the age of AI, is the only moat that matters data. If Palo Alto sees 1.5 trillion events and the competitor only sees a billion, is the game already over before it starts? Can a smarter algorithm beat bigger data, or does quantity have a quality all its own?
That is the question that will define the next decade of tech investing.
Thanks for joining us on Smart Wealth with Joshua. We'll catch you in the next one.